Good evening and welcome, or morning and welcome. We teach an evening class here, and usually I'm oriented for the evening hours, but welcome. I'm hoping everybody's had their coffee breaks and breakfast to be recharged for today. How many of you came to my Social Security planning workshop? So, gosh, a good number of you. So welcome back. And you already know this because I shared it with you in the class, but over 10,000 baby boomers a day are retiring. That is one baby boomer every 8 seconds. So that certainly presents a lot of issues and a lot of pressure, if you will, on government entitlement programs that we're going to talk about and look at. It also puts a whole lot of pressure on what choices you have entering into retirement. How many of you have retired already? Just a quick show of hands. So about a third of you have retired. And so we're going to cover the issues of pre-retirement and then post-retirement and get into more details. My name is Warren Wall. I think you have a kit, a little bio in your kits about me. A little quick summary for those of you who don't know me. That I am a certified financial planner. This is what I do for a living. Unlike some courses and classes you've had in the past that might have been taught by individuals who are book learned, this class is taught nationwide by folks practicing in the field of financial planning. So I plan to bring real life, real client experiences to the classroom. Also, I'm national certified with the National Social Security Association. And what that means for you is that for those of you who are still trying to figure out this thing called Social Security and what the best election decision is for you, I've been trained by this membership to help my clients make the very best decisions they can in terms of their election for their Social Security that will end up producing the maximum lifetime income stream for the household. So we'll talk a little bit more about that. This course is actually a two-part course. This Saturday morning we're going to digest a lot of information. As a matter of fact, we're going to be covering the Foundation's book here. We're going to go through an awful lot of material. And I'll share with you that this material could really fill a whole semester of information. So what's going to happen, it's going to feel at times like a fire hose. I'm going to let you have it. I'm going to give you lots of good stuff. But I want you to know this is a two-part session, that this is the education part. You're invited to come in for a personal strategy session with me to help you bring your personal questions that are going to come from this discussion. Bring those to me in my 1 hour appointment with you. It is complimentary. It's part of the tuition that you paid. And when you come in there, we'll talk a little bit more about what to bring with you. But that is the opportunity you will have to take this information you're learning and figure out how do you apply it to your own lives. So ultimately, we don't have the time to address a lot of personal questions. I know you're going to have when you start hearing this. You're going to say, but Warren, I'm this old, I have this much income, what would I do? I just can't, unfortunately, we could do that in a semester class, but in this shorter term period of time we have together, we're not going to be able to do that. So bring it with you to the personal strategy session. I will tell you that, this is the bylaw. Oh, and before I forget it, you have a yellow sheet, and so those of you who have not yet done it, to sign up for that personal session with me, there are dates and times that have been set aside in the yellow sheet. Sometime during your lunch break, ideally, drop off your preferred dates and time with Kim. And by the way, Kim and Bryce in the back are my associates. Thank you guys for being here to keep me out of trouble. We also have Taylor in the very back who's doing a video of this class, the point of which it's a training video for my firm, and so no names and things will be mentioned and won't be public. So with that said, thank you, Taylor, for being here as well. This is a disclosure that I'd like to share with the class before we start. We're going to cover a lot of information. It's educational only. It's not intended to provide you with tax advice, legal advice. Our program is not a government program. It's not endorsed by a government agency. We're going to talk about hypothetical situations and illustrations. That we're going to talk about various returns. They're for informational purposes only. There's no guarantees behind those returns, nor are there expectations that that's the return you will get. So we're going to look at some history. We're going to play the what-if games to help you in your education of learning about things you can and should be considering doing. All right, this is a little housekeeping, and we're going to start and stay on time by breaking about every hour on the hour for bathroom and water breaks. You do have water on your table, which means you will need to go to the bathroom probably shortly. And the restrooms are out back here. You know, there's a couple of them here, I think, on the main floor. If you need to go downstairs, there's bathrooms there too. We're going to have a lunch break, 30 minutes. Depending on the view of the classroom, we're going to serve you lunch. If you would like to work through lunch, part of your lunch to get out earlier, I'm happy to accommodate. But if you want your full 30-minute lunch break, we'll end at 2:30. If we have some consensus that we'll have sandwiches and all brought in. If you want to have part of your luncheon while listening, we can get through the material a little bit quicker.
Well,
okay?
like we can eat and listen, but what about you?
Oh, I'm good. I don't need to be eating any more than I've been, so I'm fine. I'll be okay. So, thank you for thinking of me. I appreciate that. This course is based on the book Bats, Stocks, Vegas, and Conservative Investing, or in part, and I'm trying to dig for my book, but if you see, can I borrow yours 1 second? So everybody sees the book. This is Dave Vick, who's an author of this book, and he's also a top ranked financial advisor out of Scottsdale, Arizona. I met Dave a few years ago, and the way I met him is he was featured as one of the very top 10 investment advisors nationwide for having written this book in concept on what we call ABCs of investing. And so some of the topics he's dealing with in this book we're going to talk about through our workshop and hopefully help you digest some of those cool ideas that he brings to the table. Also, the book, or planning book, we're going to go through is The Foundations of Retirement Planning. You'll see that Dave Vick is the author of this. You'll see my name on there as well. I take small credit for one of the articles that I contributed to the book, and we'll refer to that here later on in one of our parts that we'll be talking about. So let's dig in. And the way, this will give you an overview of what we're trying to accomplish today. I'm going to have you turn to, let's see here, Changing Landscapes. This would be page 6, and let me show or walk you through a little bit of what I'm trying to, in terms of time and timing, what we're trying to accomplish today. Changing Landscapes is the concept that Dave Vick introduces for those of us who are close to or already entered into this thing called retirement. And the class itself is built around dealing with and looking at some of the challenges that stand in our way. So if you will, the first half of this class up until lunch is going to be looking at the challenges we're faced with. And here's the challenges that he's identified that are primary obstacles of retirement. He talks about 8 of them, and they range from life expectancy, inadequate savings, inflation, taxation, uncertainty in the markets, rising health care cost, unrealistic expectations, and poor decision making. So we're going to cover that a little bit in general. Then we're going to focus on the 4 goals that he thinks is the most critical, and I concur they are. They are as follows. Here's the 4 main goals. How to conserve assets. Don't lose it, right? How to generate dependable income. Ideally, dependable income in our retirement. You know, what's going to stay and be there for us. Guarding against inflation and limiting taxation. Those are the 4 goals that we're going to cover again in our classroom. When we come back or during lunch, however you decide, we're going to look at sources of income in retirement. We'll just kind of think about together what are those things that we have now that can produce us income in retirement. That will cover things like qualified retirement plans, corporate pensions, what are called personal pensions, after-tax savings accounts, tax-free accounts, and the most concern to many of you is this thing called entitlements or Social Security. You know, what are some of the things we need to be thinking about in terms of how we elect to take out from Social Security, the choices you have. And then last but certainly not least, the last portion of our workshop, we're going to deal with some tips for retirement. Specifically, the one I'm really going to focus on is one of the articles I wrote for the workbook, and that is how to protect your red money. And protecting your red money is the color code that David Vick assigns to assets that are higher risk, stocks and bonds. And for those of you who own stocks and bonds, and by the way, many advisors, me included, think you should have something in that bucket. The question begs, how do you protect it? If you're going to own stocks and bonds, what are some strategies you should think about to minimize risk? Sound like a lot? Well, it is, but we're going to go through it. That's our lay of the land. That's our landscape for today's class. I do want to encourage you guys too. We'll get through as many questions as we can, and so if you have a question that comes up as I'm talking that you would like to raise that you think everybody else would like to know as well, please, raise your hand, ask me, and I'll cover as many as I can. All right, so let's dig into the book here. If you go to page 8, these are some statistics that Dave brings up, and of course we're focusing on folks that are born between 1946 and 64. If you will, focusing. These are the baby boomers. As I've already pointed out, one is retiring every 8 seconds. So if you want to do the math of how many seconds there are in a minute versus an hour versus a day, you come up with almost 11,000 people retiring daily. So there's a lot of us in this wave, and it's impacting a number of the services and benefits that you and I are expecting. That includes the Social Security, Medicare, Medicaid for some, how it impacts health care costs, and then nursing home costs and the impact of living longer and all that on this. Of course, one of the biggies is going to be this thing called Social Security and the issues related to that. On page 9, I'll bring it to your attention in the workbook. This kind of in the center, lower paragraph center, the author is talking about on the website of the Social Security website. Have you been on there yet? And I'm going to encourage you to, and we'll talk about that later. There's a warning. And the warning is a label that the Social Security Administration puts on there that says after the year 2020 that the funds in the trust fund that supports Social Security reserves is going to be gone. It's going to be depleted. And that the taxation, payroll taxation, will continue to support the obligations to about the year 2033. At which time they say that if nothing is done, 75% of their obligations to you and I can be paid. That means 25% of it goes away. So we're going to touch on that on the section about Social Security, but of course that's certainly a leading concern for many people, whether or not that will be around. As a matter of fact, that may lend itself to the Gallup polls that are done, and this is one here that is saying, 53% of us don't feel comfortable enough to retire. 73% of us plan to work in years after our retirement, the thing we call it encore careers, right? You're not really retired, but you're leaving a job that you left and had for years into doing something else that you might be more part-time or more enjoyable, less stress, thank you. And 31% believe they're going to struggle financially. I haven't seen your worksheets, and I'll look at them at the break, but this is certainly one of the top concerns of many of the students that come to the courses we teach. 62% have lost money in one of four areas: workplace savings plans, personal investments in their IRAs and 32% in IRAs. Let's see here, 29% they've lost money in real estate. Anybody looked at their statements lately? Invested in the stock bond markets? Of course, that's a concern. And that's a real issue as we go into retirement, this thing called risk. What are we doing to minimize the risk that we're taking, especially now that we're at that stage of life, or will be shortly, where we have to start withdrawing funds, correct? So we'll put some attention on that. So it's no doubt that it says 4 out of 10 adults are not confident about their retirement. And that's true for most surveys that we've seen conducted. All right, so let's dig into some of the challenges. And again, I have to ask you, and I think you know the answer. What's the number one fear of retirees? Running out of money. So that kind of goes back to the confidence surveys as well. But let's look at some of the challenges. And again, we're not going to go into a tremendous amount of detail here because we just don't have the time to do it. But some of you, I know, have gone online and looked at living2100.com. Okay. How old are you going to live to? Just some...
94.
94?
103?
I'm sorry, who said that?
Me?
You're 103 pounds?
No way.
Okay, if you haven't gone online, it's a website that allows you to plug in some history, family history, and some health habits. And it calculates a projected life expectancy. So we know Pam has she's got great health in her history, has very little cancer or heart disease in her history. I'm guessing, Pam, because by giving these different pieces of information on the website, you're going to come up with, who knows when you're going to die, but it will come up with some projection about the expectation that you should be planning for. And for many of us, not all of us, but for many of us, what we're finding is that you've got to be thinking about how to plan for a lot more years than maybe our fathers and our grandparents, our parents and grandparents, and so our life expectancies may be stretched out to the point that we really do create some issues and obstacles that we need to be prepared for. Okay.
What was that website?
www.living2100.
Thank you.
Living2, TO100.com. Spelled out, living2100.com. So let's, we could play this Q&A about who's the oldest person you know, but I was just looking through the Asheville Citizen-Times last week, and I was going through the obituaries, which I do. And if any of you are watching the obituaries, who did you see in there? A lady who passed away who was 100 and what? Did any of you see this one? 105.
No.
And it's not uncommon to see people hitting their late 90s, right, and passing away. So certainly this is real. And according to the tables, now this is a little dated, but it hadn't changed a whole lot. But the way to read this table is that a life expectancy table that's on the Social Security website says that a couple, age 62, at age 62, one of those two in a couple will live to, a 51% chance, will live to their 90s. Again, that's just what this life expectancy thing is, that there's a greater or 51% chance that one of the two of you will live to or in your 90s. Okay? So, and that's going to be important to us as we talk about Social Security elections, if you're married, and the impact of that. Okay, that's item one of a challenge that we're going to touch on. The other is the inadequate savings picture. And, there never seems to be enough. And if you go to page 16, there are some reasons for that for many of us. And these are some of the challenges that we're seeing from the studies of savings. It's this, what's identified on this chart here is that the average savings rate or amount that we save has come way down over the years. Back in the 70s and 80s, we were on average saving 5 to 7% of our income setting aside. If you'll note here, the personal savings rate since 2007 has dropped down to 2.6%, so well below the historical averages that we've seen in the past. Now, there's some reasons for this. Well, this is a quick note here that says that based on the average disposable income of around $32,000, if you apply that 2.6% savings rate to that number, it says that on average people are saving around $849 a year. Does that sound like a lot of money to be saving that will meet your needs in the future? Probably not. Okay. All right, so why are people struggling to save? And this is according to the author, there are several reasons why we've been dealing with some of this, the difficult issues of saving. On page 19 of the workbook, he lists a couple of things. One, easy access to consumer debt, spending well beyond our means, wages being stagnant, So in other words, especially since '09, since the recession, for many companies, employees have not seen wages increase relative to the real rate of inflation. I know there's some teachers in this room, or retired teachers, who also are very aware that teachers' salaries have not increased for an awful long period of time, or so it seems, but it's certainly 8 years, yes. So the point of it is, we're not seeing the increases that we saw historically in rates of our wages. We're seeing now, it's not uncommon for me when I do reviews for clients to see in our phase of life helping grandchildren out with college cost and expenses. If we ourselves have that debt and are carrying that debt into our own retirement, that's certainly a burden. But as grandparents, if we're helping out grandchildren, doing the same, it certainly adds to our issues in retirement. Of course, market downturns, decimating values of accounts and the monies that we were depending on for our retirement. Disappearing pensions, we're going to talk more about that, but many companies no longer offer this thing called a pension, which was a guaranteed check that says you worked for me X number of years. I'm going to give you something for all those years of work and hard labor. And those are going by the wayside. And then, of course, companies doing away with health care benefits for their employees. So these are certainly reasons why many of us haven't saved the monies that we need or would like to have in retirement. This other thing, inflation is a silent chipper away of our savings. And again, if you look at some of the polls, well, we can just look at the numbers and use this as a benchmark, but this is a car. If it was $25,000, and of course that'd be cheap in today's world buying new cars. But if inflation is 2.9% and you go 10 years, what's the price of a new car? 33. 20 years out, 44. The point of it is inflation means the prices of goods and services we're going to buy in the future are going to go up by whatever that CPI generally, whatever the CPI rates are. So, we need to plan for the possibility that, especially when we do retirement planning, and it's very common when folks come in and we look at what their needs are, their wants are when they retire. So often, people will get out their own spreadsheets and project that I have this much money to retire on, but the piece they leave out is what? Inflation. Meaning that what goal you have today for income has to keep up for the future, right? If it does not keep up, what happens? Your standard of living has to go down, or you run out of money, right? If you keep spending at that same level. So, yes, sir.
Why does it go up to 4.3% for last 10 years?
And actually a good question. It has not averaged that. Is that what you're saying? Or, it's just a number.
All the
It's,
others are
I think the author in throwing this out there is to say, what if inflation got higher than 2.9? Actually, 2.9 is the 20-year historical average. But there's some arguments out there that inflation may go higher. Inflation in the last decade's been pretty low, hasn't it? We know things go in cycles, and there's some reasons we're going to talk about them in class why things may get hotter with inflation in the future. So good observation. All righty, so we know it's with us for life. It creates uncertainty in terms of our planning. And, you know, these are some comments that are in your book about inflation, how if the average purchasing power, if you have inflation of, you know, 3 to 4% a year, the value of your assets are cut in half in terms of purchasing power every 23 years. So $100,000 in 23 years buys only $50,000 of goods and services in using today's values, right? That's what inflation is telling us. Okay, so, and you know, this is also, this is funny. I think this is a little bit dated question. And, you know, it was a very useful question there for a while. And the question was, what is the cheapest gas prices you've ever paid? And
27 cents.
27?
12.9.
12.9 cents.
I use
That-
big cheese gas.
I was going to say, with lots of ethanol in it mixed into it. But ultimately, I mean, it's a bad example to show now, because what are we seeing happening now? It's dropping like a rock. So
Not going down to 12 cents though.
that what?
It won't go down to 12.9.
Oh no! That is a low price. But you know, some are
It's in the 60s.
60s. So some of us, I say in the oil and gas dialogue and gluts that may be going on, are talking about $1 or less per gallon gas. I was in South Carolina last weekend, and I paid $1.37 a gallon, and so it's certainly heading that direction. So again, maybe not the best example for inflation, but you know, generally, you know, things like that over time will generally go higher. And of course, I think of the first house you might have bought. For, you know, obviously another example. You know, my parents brag about how they paid $20,000 for their house, and it's, you know, who knows? It's now worth $300,000, $400,000. Crazy. Okay. The other issue, this thing called taxes, and a comment or two that we'll make about taxes in the book. This is page 24. If we look at a chart, this is, well, I'm sorry, I'm a little bit, yeah, here we go. These are some of the numbers on page 24 at the top. Just a little historical on the tax rates that we pay. In 1944-45, the highest tax rate, highest marginal tax rate was 94%. People forget how high it has been. Highest marginal brackets in various other year periods of time, 80%. 70s to 80s, 70%. Historical average, since we've had a tax rate of 59%. And it goes on to say there were two marginal brackets from 88 to 90 at the lowest low, 15 and 28, depending on your income. So the point of this chart is that we're graphing from back to 1913 forward the movement of our marginal tax rate. And what you see, of course, is over the history of our tax record, we've seen it bounce around a bit, right? Here's the median. That's that dark line there that says the average median is 59% marginal bracket. Does everybody see kind of where we are right here now?
What do you mean, Warren, marginal?
Marginal is that we're in a tax tiered system, that not every dollar is taxed at that rate. The first lowest amount of dollars at a lower rate, in the highest income brackets, that marginal bracket is the highest tax rate we pay. Yeah. So that's the highest rate you could have paid. It wasn't meaning you were paid 59% tax on everything you earned. Everybody understand that? So, but here's the discussion. Where are we right now? Kind of where?
35?
Yeah, kind of on the low side. It's actually gone up recently, I mean, say within the last couple of years, to 39. 39% is the highest bracket. What is 39% right now relative to our history? Low. So some people are thinking, if indeed things go through cycles of time, there's a real possibility that tax rates may go where? Higher. And there's some real reasons why, and this is one of them. I don't know if any of you have had fun with this and gone online, and actually you don't want to do that, it will depress you. But you can go to usdebtclock.org. When you hit it, it's a live running spinning wheel that calculates for you the national debt. And at this time, this was done last year, it was $18.1 trillion is the national federal deficit, and the debt was $18 trillion. Everybody with me? Okay, so for fun and kicks, I opened up the thing today, or this morning, and it's now almost $19 trillion. So it's gone up $1 trillion in the last year, and it may obviously continue to grow higher. What does this mean to you and I? It means there's a real possibility that something will be done or have to be done to reduce the debt. And how do you reduce debt? One of the ways is you increase taxes. And so there's a possibility that U.S. debt obligation is going to cause it. There's other issues that certainly could cause our tax rates to go. Obviously, we're going to talk in more detail about health care cost. This thing called Medicare, Medicaid, can it continue at what it's doing at the levels today? And many will tell you no, it can't, that eventually something has to be done to fix it, and that have to be done to fix it means what? Possibly higher taxes out of our both earned and investment income. The other is just simply, as we're going to look at more depth and detail, is Social Security entitlements, which basically tells us that we're going to run out of money or be potential of having reduced benefits if we don't do something to change it. What is the change they're referring to that will help ensure and firm up Social Security? Rising taxes or on payrolls and possibly lower benefits. So it's not unreasonable to think about for the future that you need to plan for how to manage this thing called taxation in a smarter way so that you have more of your money to keep, right, in your retirement. Okay. This other issue that he brings up as an obstacle, of course, is market uncertainty. And again, I made note of this, about looking at your statements. The reality is, if we even look at within the last year, the market is in what is called a correction right now, right? From the highs in May of last year to now, the market is down 10%. And we're going to look at this thing called bear markets. Bear markets, this is correction. In a bear market, how down does the market have to be in a bear market? 20% or more. And we'll look at this thing called bear markets. But obviously this causes us great concern. I'm going to show you the author of this book, Dave Vick, on page 28, shows these numbers as being kind of speaking to this. He says that if you look at the S&P index, which is the market benchmark, the S&P 500 is the market that we tend to look, but the benchmark or index we look at as a barometer of the health of the stock market, says that during the period 1984 to the year 2002, the average indexed return of the market was 12.22%. It goes on to say that over that same period, average inflation rate was 3.14%. This is the number that is really a kicker, that the average equity, that stock fund investor, from 1984 to 02, during the same period, the same period that the market averaged 12.22%, the average investor, stock investor, made what?
2.57.
2.57. Boy, what happened here? Any thoughts? How come individual investors did so much less in return than the market? And we'll look at some more of that, but maybe emotions got in the way and we panicked, jumped out of the market at the wrong times. Maybe somebody brought up in class expenses, investment expenses, commissions, paying those doggone fees, right? That you pay to buy and sell if you do that, right? I mean, but anyways, this is, to me, that's a number that leaps off the page. And of course, he has some other numbers here that speak to the debt and the equity, the debt of the U.S. debt that we just talked about. So I want to touch on this thing called market uncertainty. And Dave Vick shows us this chart. It's on page 34. And we're going to cover this idea more in depth and detailed on the last half of our class. But this is an illustration of market emotions of the market. If you think of markets going through cycles, ups and downs, the question is, how do we respond to it individually, right? Emotionally. And in this description of this chart, he talks about, as a market heads higher, you may or may not be an investor in the market at this stage of the game. There might be disbelief. There might, that it's even going to go higher, and you're sitting back watching the market. And then as you see it continues to go up, that feeling of hope springs forward, and maybe at some point optimism kicks in, and then you just see the market heading higher, and your neighbors are talking about how well they're doing, and we get convinced to do what? We buy into the market because our belief is, it's got to continue to go higher, and sure enough it does, right? We buy in and we're thrilled. We're so thrilled that the market's going higher, we start pondering about mortgaging our house to get more money invested in the market. We might use margin to buy more investments. This is where the crazies, if you will, start happening with us emotionally, this extreme optimism and belief. Then we hit the euphoria, and what happens? It's just like, honey, we can retire today. We don't have to go back to work ever again because our stocks and bonds are going to keep going and will never stop. And then, of course, what happens? It starts going down. It's disbelief. It's disbelief. Generally, we don't believe it. If it goes down, we think, it'll just bounce right back up. And sure enough, it just keeps going down. It creates anxiety. Well, where's my money going? Then at some point, we just stop looking at statements. Market values have gotten so ugly, we go into the state of put the head in the sand denial. I'm not going to have you raise your hands because I might be one of the first to do this, to tell you I've been here too. But then there's panic, right? And then what happens?
Get pissed off.
We got to stop the pain. How do we stop the pain?
Get out.
We got to sell it. We got to get out. We sell it. And you go, you put it behind you eventually, but then what happens. What happens eventually. Eventually it starts all over again, right? And it's going, this cycle of emotional investing, if you are a human being, is hardwired in all of us. It's the thing called fear and what? Greed. Fear and greed. It's what we're hardwired to do. So part of your lessons that we're going to learn later on in the class is what can you do to help protect yourself against yourself and those hardwired emotions. We're going to look at strategies that help you minimize, hopefully, this cycle, this cycle that creates havoc on portfolios. Alrighty, so, this thing about stock and bond investing and how much you should have invested in that category we're going to look at more closely with the Dave Vick ABC program about how much of your assets should you be thinking about having invested in the stock market and bond market. We're going to look at this chart a little bit more. I'm going to skip through it. We kind of addressed this issue earlier. But I want to touch on this one. This is health care cost. And these are some numbers that, let me find my page marker here. If we go to page 35, these are some of the issues that we need to be thinking about in our retirement, some of the numbers that we can look at. That back in the 70s, 1970s, we spent $75 billion in the health care. The U.S. spent this much in health care. That would be the Medicare, Medicaid arena. That number has jumped up since in the year 05 to $2 trillion. So a substantial amount of increase. Again, part of the baby boomer bubble, right, aging out. More of us are coming to the forefront. The percentage of healthcare spending as a part of the gross domestic product in 2005 was 16.2%. That's what, as a nation, that's the percentage of our wealth that we directed towards this. The amount that is expected, and we'll get the final numbers shortly, but for the year 2015 went to $4 trillion. So the way to look at this, from 05 to here, 10 years, in just 10 short years, our costs have more than doubled. Everybody following this? As a matter of fact, as a percentage of our GDP, it's now jumped up from 16 to 20%. So the numbers are pretty shocking. This is ultimately what it's telling us, that we have to do something to preserve the integrity of those programs, and there are things being done, and these are some of the issues to be aware of. On page 35, these are some of the these are some of the things that he's identified or brought to our attention, the things that have happened from the tax code to help shore up these deficits. Payroll taxes have increased already from 1.45, they just went into effect, to 2.35. So workers now are paying greater payroll taxes. The amounts that you pay on Social Security and the amounts towards the Medicare cost have gone up as well. The deductions have. There's a new tax, 3.8%, that is being tacked on to the marginal rates that we pay on our tax rates. That is another additional tax to help fund the Medicare cost and expenses. Not all of us will pay that 3.8%. There are certain income levels that you will. We, of course, know about Obamacare, right? We know state exchanges are in place now to help minimize or hopefully lower the cost of health care. You know the mandate is now that if you don't have it, you have to pay, if you're not covered, you have to pay penalties. And I think that started this past year, tax year. And those penalties range anywhere from $95 an individual to $285 per family. So again, and of course Medicaid is expanding, or I should say the government's attempting to try to expand Medicaid or encourage states to expand Medicaid where they will do it. North Carolina, unfortunately, is not one of those states, and that's my personal bias, but long story short, we have an issue, we have a problem, and that means that these problems are being addressed. Certainly these are concerns for us going forward in the future. The other issues around health care, of course, is health care cost. This is just showing us some of the numbers about nursing home care cost jumping up. How many of you people know somebody who's ever gone into a nursing home? Okay, most hands have gone up. After this program today, I leave for Spartanburg, South Carolina, my hometown. I go to visit my parents, who we put into a nursing home last weekend. Now I say nursing home, assisted living. They may not be there forever, and hopefully they won't, but they need the help now. But it is not uncommon, is it, to have to think about these choices. And as we'll see, the cost of these choices are pretty extreme. As a matter of fact, this is just a summary of cost related to care. If you do it in the home today, these are averages nationwide. They're a little different everywhere. In my hometown Spartanburg, my parents were paying actually just at the $18 level for people to come in. These are homemakers, come in, take care of the house, feed, cook, that sort of thing. That's not skilled care. That's not nurse care. Median cost of assisted living has been rising on average of well over the rate of inflation, 4.3%. Median cost of private nursing home has jumped to $67,000. That was 2012. It's now even higher. It's over $83,000. We're talking nursing home care, okay? So these expenses that we're looking at, how are we going to pay for those? And when I do financial planning, one of the key things we look at is when we think about this thing called income and how much I'm going to need to live and live on. All it takes is one bad health care situation that can wipe out the plan, right? If you're having to eat into the assets to pay. So how do you manage that risk? What do you do? We'll look at that more closely. Of course, again, this is just another summary. I have shared this with my classes in the past. Of course, my parents being in assisted living is the story that is most current. But before my parents went in, this is my grandmother, and these are my 3 siblings. There are 4 boys in the family, about 2 years apart. No, I don't know what this is. I'm sure he's not going to the bathroom, and it's not a squirt gun. But it's an old picture. And but what I wanted to tell you is that both of my grandparents went into a nursing home in their late 80s and early 90s. My grandfather outlived my grandmother. She passed before him, but he lived to age 95 and only passed because he fell out of his bed, he broke his hip, and when they put him under the knife, he died on the table. But the point of it is, my grandparents, I know, had hopes that they wanted to leave an inheritance to the grandchildren. My mother had passed, and we were their only offspring, or heirs, if you will, of whatever estate they had. Upon the time my grandfather passed, there was nothing left. I mean, it had all been spent. Can you guess which one I am?
The yellow shorts.
Thank you. Yes. I've had a few people pick that one out. That's my older brother, Moose. Moose is 6'8". Wow. He's about 300 and a quarter right now, 325. He's one big boy. Yeah, yeah. That's where the name Moose comes from. and all of us are over 6 feet. Well, but this is my youngest brother, Philip. He's the shrimp of the family. He's actually 6 foot. Everybody else
Your
goes up.
grandmother's tall.
She is, actually is. Yeah. All righty. Unrealistic expectations. This is page 39. Let's touch on that. And, this is at the very top of the page. They're referencing that according to Fidelity, it says 4 out of 10 households can't cover their monthly expenses. And the research went on to reveal that 50% of Americans have less than $25,000 in savings. So, anyways, what's causing the problems in savings? We've touched on this already, but I want to touch on this as it relates to retirement. What happens in retirement once you enter into retirement that could be an issue? Spending too much money in the first few years of retirement, right? Hey, this is fun. Let's go. Let's get on the cruise and go around the world. Now, there's nothing wrong with that, right? If it's planned in accordance to what you can afford to do. But some people get extreme there. They underestimate home repairs, helping out adult children, taking care of elderly parents, not planning for the rising cost of health care needs, and may have the responsibility for a special needs child or grandchild. So these are things that can interfere, right, with the planning that you're thinking about that you need to concern yourself with. This is developing a retirement income prediction in terms of planning for retirement. These are the kinds of things that we want to look at. And what I did here, I went ahead and just wanted to show you an example of unrealistic expectations. This is a couple who were age 58 and 56 when they did this plan. They were both still working, and they decided they wanted to maintain the same level of income that they were earning in retirement. That was their goal. And they were going to retire at 66 and 64. So husband, wife, that was their goal. And they were going to start drawing their Social Security at his age 66, her age 64. And they had the estimates of Social Security built in here. And then the wife had a small pension that was going to pay her. And so what we did is we ran the numbers of their goal at $10,000 a month to see if their account would survive that kind of withdrawal after accounting for inflation. And what happened is what you see, this is on page 40. And on page 40 you can see this is not the kind of slope we want to see our assets take in our retirement planning. What happened? They ran out of money, yeah, by something right around 78, 79, or 78, right?
And they had over $1 million to start with?
Well, they had $700,000.
Oh.
So they had a $700,000 bucket of assets that did grow until they retired. So you did see it jump up to over $1 million here, but then it quickly was spent down after we calculated what their goals were and inflated them. Everybody with me so far? So what we did, we went back and reevaluated the goals, and instead of 10,000, we used the ratio of 70% of that as a goal, which is a very common thing to do in retirement planning. To say, all right, I live on $10,000 a month while working, but when I retire, I'm going to take 30% less in my retirement years, or plan for that. That's what they did. They dropped it to 70% of their goal. Long story short, you see the money lasted. And so again, unrealistic expectations, if you weren't paying attention, could have led to this, right? When would you want to know this is a possibility? Now, before you retire, right? Because why would you enter into retirement without a plan for what is the appropriate level of income you should be drawing relative to expectations of inflation and such? Would you agree?
My
Okay.
neighbor said that her parents ran out of money because they lived to be, over 100.
And that's part of that longevity issue. And how do you plan? Do you plan for your money to last to 100?
I don't know.
And again, this is part of our challenge, isn't it? When you do your planning, do you plan to have money available until you're 100? And those are some issues that are personal. One of the things I would say when you do your living to 100 diagnosis, I would plan to at least that. I mean, it's a benchmark that says a pretty relative expectation based on family history and lifestyle. Why not plan for that? All right, so how do we get out of unrealistic expectations? Part of the steps out of that is have a budget. And I know that's an ugly word. If you go to page 125, I just want to make sure you're aware that in your handouts here you have, or your booklet here, you have a retirement budget worksheet, page 125. One of the exercises I would encourage you to do after the class is, sit down and look at what you're spending. Sit down, if you're still working, look at what you're spending now and then kind of project what it is you might be spending in your retirement, okay? It really needs to start with a budget to help you crystallize where, and I call it needs and wants. What do you need? That's your first budget, isn't it? That's called survival. The other is, what are your wants? Yes, I want to travel that cruise ship around the world. That would be a want, right? Can you afford that? Well, that would be part of the financial planning that you want to do, is to see if your monies would last through those kind of expenses. Okay. This other obstacle that we'll talk about is poor decision making. And this is where we touch on some of the challenges of personality and how we make decisions. I say personality, our makeup, and internal makeup. How do we make decisions? And the author speaks to investment temperaments, and this is on page 43. On page 43, he defines 4 temperaments of, as an investor. And maybe I'll speak through these. Maybe you can kind of think about where you fall All right? So if we look at what we call the red, it's someone, and again, this is at the bottom of page 43. Red is someone who most often confidently is impulsive in their decision making. They have difficulty saving money because they love to spend it. They are usually very optimistic, impulsive, and risk-taking. Okay? Green, someone who thinks in concrete blocks. Greens have to have 4 reasons to choose a path, or 3 reasons for deciding on an asset. They like guarantees because they want to feel certain about their direction, very driven to save money, and highly goal-oriented. They're very ambitious. They want to get it done right now. Okay? Yellow, they're a very easygoing personality who might wait until tomorrow to make a decision. They prefer stability and they fear change. Yellows are very rational, they're observant, they're able to manage a plan effectively once it's set in place, yet they don't like to make the final decision. And as I'm walking through that, I'm seeing people nodding and pointing, and then blues, they need plenty of details. They often get paralyzed by over-analysis. We need information, or we'll need information, and most often take a long time to see through the details to a conclusion. It goes on to say, once the decision is made, blues always second-guess themselves. They're very cautious and they're somewhat fearful of the future. Okay? So the exercise in here, if you want to do this when you go home, is on page 44. You can kind of put an X on a line of, where do you kind of feel like you fall. But the point of this discussion is your beliefs, your feelings have impact on how you make decisions. I could share with you the grandfather I told you who passed away in the nursing home grew up in the shadows of the Depression. How do you think he felt about taking risk in the stock and bond market? He did not, all of my life, all of my years in the industry, he never bought a stock that I was aware of. It all stayed in the bank. Now, by the way, that was back in the day that the bank actually did what? They paid you something.
Yeah.
I mean, why would you take a risk if you could put your money in something guaranteed and it would generate double-digit returns, right? Or you could buy government bonds that would pay you double-digit returns. And so it was easier not to take risk. Do we have that luxury today? No. Not at all. We'll talk more about that. Okay. So, again, the idea is that we are all encumbered by beliefs, emotions, and logic, and that we have to be aware of that in our decision making. So the key here, and this is what the author speaks to on page 48, and that is that you really do want to have a process. You want to have a process to make decisions in planning, and this is making this is the process that we follow in our own firm, is that in working with a planner, you want, the process that I would encourage you to do is go through what I called investigation. And when you sit down with someone, you're disclosing what's going on in your life, what your concerns and issues are, what are you doing now. The investigation means someone who's helping you has to be in a position to understand what it is you're doing today. The second is, with that information, is a recommendation. The recommendation is taking a look at the details and the needs and then coming up with a recommendation that will fit and accomplish those goals and objectives. The third is to implement, meaning once you have that determination of what's necessary, is moving forward, is actually implementing what it is that your needs are. And then last and not least is review and adjust. That is a process by which you inspect what you expect. If you do a plan of any sort with anybody, once you start that plan, do things change? Always. The changes in the economy, changes in your life, changes in your needs. So adjusting or inspecting what it is you started with and making sure it's still on the right track. Does that make sense? Okay, well that would be the steps that we would recommend you consider following. All right, I have right now about an hour since we started. Let's take about a 5-10 minute break, or let's make sure we report back at 11:45. Okay, fair enough? So restrooms and all. So we're going to dig in, page 51. We're going to start with the goals. You remember there are 4 goals we're going to cover that we think that are extremely important about how to go into this thing called retirement and protect what it is you accumulated, what you've grown your assets to be. How do you protect these assets going into your full retirement? So this is the Conserve Your Assets. If you haven't yet done it in the book, Bet Stocks, Vegas, and Conservative Investing, that title's a mouthful. But what you're going to learn more about in more detail is this concept called ABC planning, which is the cornerstone of how to allocate your investments according to risk tolerance. And ideally for you, it's a way for you to decide the kind of risk you're willing to accept with anything you do in terms of your investment portfolios, as opposed to allowing any investment advisor, stockbroker, telling you what you ought to do. It allows you to formulate your own plan of what you think you should do. With me so far? All right, so let's kind of dig into this. This is the ABC planning model that says there's 3 things you can do with your money. And he's color-coded these yellow, green, and red. And the first thing is you can have it in assets that are considered liquid. Assets like CDs, money markets, bank accounts, savings accounts, anything that you can put your money in which is safe, meaning it can't drop, can't go down, but it's got to be liquid. If it is all of the things we described above, that's the good news. What's the bad news? There ain't no returns in that bucket, or very low returns. But we need something, don't we? We generally need something liquid. How we choose what amounts those are subject to various rules. I can share a few with you, maybe 3 months to 6 months of need. So if you lost a job and you needed to go find another job, if you're still working, maybe a 3 to 6 month bucket there that's liquid you can get your hands on. If you're planning big expenses, a car or a house or a big repair job, you would set aside that money too, wouldn't you? That would be money you can get your hands on as you need it for that expense. Okay? So there should be something generally here that's up to you based on what your needs are. This other category is somewhat new for folks who have never looked at the categories of investments this way. But the B category is something that has to, and we'll look at this more closely, cannot lose principal, ever. It's still moderately liquid, meaning it's not as liquid as cash, but the rates of return generally in today's world are 3 to 7%. That's the range of returns in that category. This is a category that generally fixed guaranteed investments like annuities fall into. And we'll look at this thing called annuities a little bit more closely. But something that says the principal's guaranteed and the returns that you earn are not going to ever be subject to loss in the future. So if I make 3% this year and next year the stock market goes down 10, I can't lose my principal or the prior year earnings. Okay? That's the category we call green that gives us that range of return. The other category, C, this is the category for higher rates of return, typically our stock and bond market investments. You see ranges here that say 30% it could earn or even higher, but certainly it has the risk of what? Dropping. So that's the category that we also need to think about is an appropriate percentage for you in terms of your risk tolerance and expectations. What is that for you? So we come up with an allocation, and usually that allocation first is built around what do you need for emergencies? And by the way, I said what do you need? Because if we have too much here, what's the problem? We're losing money. We're really losing money, aren't we? And you remember that ugly word called inflation. If my money is sitting in a bucket that's earning almost nothing and inflation is chipping away at it, right, then I'm losing purchasing power of any excess funds that I'm maintaining in this bucket. Everybody with me? Okay. So the question here under C is, well, what belongs in the red bucket? And again, I'm going to share a rule of thumb with you. This is, again, this is not hard and fast. But one rule of thumb is the age of, take the number 100 minus your age. Whatever that number is might be the start point of a percentage that you would invest in the red bucket. So if I was 70 years old, 70 minus 100 is what? So 30% might be very appropriate for someone that age, okay? What happens when I turn 75? Where's that percent go to?
25.
So it's naturally what? Shrinking as we get older, so that we're taking what? Less risk. So that's, if you will, that's kind of the global perspective. But let's look at it a little bit more closely. If it's a green money asset, so I want to clarify what this is because this can sometimes be confusing. I've had people come up to me and say, well, Warren, is this where bonds belong? And the answer is no. And the reason is, can bond values go down? Yes. Absolutely can. And they will go down when what? Interest rates go up. Bond values drop. So because that relationship, you see bonds belong in the red money risk category when you're classifying how your assets are invested. Okay, so what's a green money rule? You got to protect principal, got to protect gains, got to protect income that it can produce. Those are the three rules. Red money rules. In the view of the author and myself, the rules are it must be tactical. And we're going to talk about what tactical means versus buy and hold. Okay, we'll look at what that is later. It must be liquid. In other words, money invested in stocks or bonds should be liquid. You should be able to get to it if you needed it, right? You could sell it. You can get out of it. Must be long-term. It's not designed to be invested for short-term money. It's intended to be long-term. Everybody with me? Okay. So, if you follow the rationale here, A, assets are cash, potentially lower returns as we've heard. B is protected growth. C is risk assets. If we want growth or gains, what are we giving up? Guarantees or protection. If we want liquidity, what are we giving up? Returns or gains. If we want protection with guarantees, what are we giving up? And the author suggests it's liquidity. And that means if you go into those kind of investments, there's usually certain restrictions that when you pull money out, you're subject to potential penalties if you come out beyond or before certain time frames. But he says moderately liquid because most of these products allow for a free withdrawal up to 10% per year generally. So it does provide liquidity, but up to those levels. Okay, yes?
This is going to be a vague question, but you may know the answer. My mom had annuities, and she lost her principal because of the type of annuity it was.
Yes, thank you. We're going to look at that. As a matter of fact, when I use the word annuity, there are two types. There are the B class type annuities that protect the principal and the gains and the income. You're going to learn about, there's a red type of an annuity called a variable annuity that is totally subject to the market risk up and down. So good question. Yes, we'll look at those a little bit more in depth. But I want to stress this point. Well, I'll ask you, is there any investment that you know of that does all three for us? And the answer we all know is what?
No.
No. So don't ever let anyone talk you into believing that any one kind of an asset can provide you with all these wonderful benefits. It doesn't exist. So therefore, we have to look at our investments in the way of asset allocation. What are we doing to diversify according to what our needs are? Okay? All right. Now, I did bring this with me to show another illustration of what a green money asset is. I'm not sure this one is in your handouts, but this is another type of annuity called fixed indexed annuity. And we'll learn a little bit more about these, but fixed annuities are annuities that provide just like a CD, it provides a rate of return that's guaranteed by the insurance carrier, the fixed rate of return that you'll earn if you own it for a certain period of years. It's like a CD at the bank. And just so you know, today's world of fixed annuities are around 3% a year, guaranteed and locked in for up to 5 years. That's the world of fixed annuities. They have a product in the annuity world called fixed indexed annuity that says instead of giving you a fixed rate of 3 or whatever it is, instead the rate of return you earn is indexed to a market indice. It could be the S&P 500, it could be another form of an index that says the rate of return they credit to your account each year is based on the performance of that market index that you're aligned with. So here's an example that I'm using, and by the way, it's an example. It's not what I'm telling you to go out and run out and buy. This is a historical illustration just to show you how it works. This company had an indexed annuity. This is and it does exist. It is out there, but this is a 1998 investor who put $100,000 in an indexed annuity to the S&P 500. And what you're seeing is the year as the market goes up. Here, do you see the green line? This is the annuity which participates with the growth of the market, but not the full growth of the market. The reason it doesn't is that there are caps or spreads that give you part of the market gain, but not all of it. Okay? So what happens in that relationship is as the market goes up, the index annuity goes up, but then markets then drop, right? And drop, and what happens is you see the value does what? Stays the same. You didn't earn anything, but you didn't lose anything. And we call that zero's your hero, right? I mean, when the markets go down. If you do nothing worse at all than not make anything when the market's getting chopped to pieces, that's not a bad thing. As a matter of fact, that's what it's illustrating. Markets decline. Then as markets ticked higher, it ticks higher, right? Every year the market goes up, it goes up. The market cycles again, goes down. What happens? Stays the same. Everybody follows what we're talking about? So here we have a vehicle in the green money basket that says I can continue to get growth of my capital, but I don't put principal or prior year gains at risk by following that kind of a product investment. Everybody with me on that? Green money is what I'm trying to talk about. All right, so that is the primary, yes?
Go back to that slide. What does it mean with the annual reset design? Is that a particular, it says real benefits of indexed annuities with annual reset design.
Annual reset means the following. You know, I said you don't fully participate with the gain of the market. Each year, the annuity company has the privilege or right to reset the cap or the spread that they charge. So, and the logic behind that is if interest rates, and you've got to understand the reason there is no risk in those kind of annuities is the insurance carrier is hedging the risk of the market decline. The hedging means they're having to take part of what would have been your gain had you been in the market, and they're buying instruments that protect the value when the markets go down. And so those cost of instruments are based on a number of things, interest rates, volatility. So the insurance carrier has the right to change that cap or spread according to whatever the costs are to put on that hedge. Point of that to you and I as investors is that it didn't cost us. There's no internal expense. It just means we're not going to make as much when the market heads higher off of that cost. Everybody, I know that gets a little bit, detailed, but understand that's what the reset is saying. Okay? All right. So this is an example of Sleepy Steve. How did he make his decision about how to allocate? Well, Steve was 70 years old. And this is the example that we kind of looked at. Do you see he's 70 minus 100 is 30%? So Sleepy Steve had an asset base of $500,000. So he decided he wanted to follow the model of his age minus 100. So he put 30% of his 500 in the red money column. He then decided that he needed 10% of his assets in cash or liquid. By default, that left the balance of 60% that fell in the guaranteed bucket. You remember there's only 3 things you can do with money. It doesn't matter what asset class you throw at me. It falls in one of these 3 categories. Yes, sir.
Is a home considered an asset?
Thank you.
Where does that?
Where does the house fall in here? It doesn't fall in here at all. Thank you for asking. The reason is you're living in that. It's not an asset you can, well, let me back up. It is, you can do certain creative things with your home. But in the broad general scope of it, it's a house you live in, an asset that you own, but it's not invested generally for income. You're living in it. Now, if you had a rental house and you're generating income with a rental house, where does the rental house belong? What category? What would you guess? C. How come?
Because it's risky.
It's risky, right? I don't know if my tenant's going to pay next month. I don't know, if we have a recession. What's the value of that house, or what it had been during the last recession? Did houses' values go up during that period? No. They dropped, so they are red money classified, okay? Good question. So that's an example of the, how to kind of start this process of deciding where you fall. As another example, and I want to show you the value of ABCing your assets. This is the same example of Sleepless Steve, who before he came to the workshop had 90% of his assets allocated in red money. And by the way, I want you to know it's not uncommon to see those kind of high allocations. People don't even realize the kind of risks they're taking with money. But he had a 90% allocation towards red money in his scenario, and he had, at the time, he still had the 10% in cash. Do you see the $500,000 I told you he had? What we're doing is looking at this period of time, going back in time to the year 2000 to 2009. The S&P 500 returns for those years are identified here, up and down. Red is down, black is good. And you see the allocation, he had 90% of his money over here. That 450 meant that the 450 was fully subject to the down market pullback. And then of course he got all the upside of the market rallying higher. But the money in cash, and by the way, cash actually earned something back then, didn't it? So you see it's earning at 3%. But the bottom line is his $500,000 at that allocation dropped to what? $417, or a loss of $82,000 over a 10-year period of time. Now, mind you, we're talking about an example where the person could hold that asset and not touch it for 10 years. What happens if you're retired and you need income and you need to draw from that bucket in a period like this? Certainly it would suffer even more loss, wouldn't it? You're having to pull money out during a very difficult down market period. Now, what if Steve had in the past allocated, according to his allocation, his ABC allocation, 10, 60, 30, that same $500,000 would have grown to over 608 for a gain of 108, and over the comparison, and the reason for it was this: the money in the guaranteed bucket, you remember when the markets go down, what happens? Does not drop, but when the market heads higher, it goes with the market. Market drops again, it stays the same, right? So what happened was, by having something in the guaranteed buckets, it preserved the wealth so that even though he had some at risk, it wasn't as heavily at risk the way it was designed earlier. So anyways, the combine or the comparison of the two was over $190,000 in this example. All righty, so the question is, how and what allocations should you be invested in the ABC of your assets? And in the book, I was trying to see here, is it page 53? There's a little blank. This is an exercise that you can take home with you and think about for yourselves. Ideally is classifying the assets you have, what categories do they fall in, and then seeing where you are and versus where you think you should be, relative to the risk you want to take. Of course, I can help you with that when you come in a little, to talk with me at your session with me. All right. Generating income is goal number 2. Goal number 2. And this is discussing or talking about a little bit the 4% rule. And to help you, we'll touch on that a little bit later in the session, but if you were to go to a stockbroker or a financial advisor that follows traditional income planning, one of the recommendations they make is to simply take your stock and bond portfolios and pull 4% off of it a year. 4% rule is what it's called. So you have a stock and bond portfolio, you pull off 4% of the value of that account, and every year you give yourself a raise, pull out more by the rate of inflation. Okay? And we're going to look at this in a little bit. I'm a little bit ahead of the game here to share this with you, but I'll tell you that there are studies that are done, or have been done, that suggest that if you do that, or if you follow that rule, there's a high likelihood that you will not have money. It'll blow up your account. I'll show you more why in a moment. I'm showing just a couple of illustrations here. I think the author put these in here, or did they? I'm not seeing that exact chart, but I threw this in here to show you on the computer. This is just an interesting thing to look at. This is a portfolio of $500,000, and in this example, I ran the numbers a little bit higher than 4% just to emphasize this point. But this is someone who had a $500,000 portfolio invested in the market. You see the year-by-year returns? And they took out $30,000 a year one, because that's what they needed. And they inflated it by the rate of inflation. So you see $30,000 coming out year one, you see it going up each year. And the good news in this series of return that I'm illustrating, started with 500, took out all this income, and what they end up with? A whole lot more. Well, more than double. Yeah. After taking out all that income.
15 years.
Yeah. So what chart do you think many stockbrokers are showing you?
That one.
What chart are they not showing you? It's the next one. I can take a different series of return. That was the decade of 2001, or the decade of 2000. And it's actually in reverse. It's just called sequence of returns. The computer's just regenerated a number of a sequence. But what it's just showing you, we don't know what the sequence of returns are going to be in any series of any year. But here's the sequence of return over the same period, blew out and went to negative in year 13. So instead of having $1 million, we had $0.
Whoa.
Everybody with me?
Whoa.
It's called sequence of return. What we don't, it's the sequence of returns of the market here that made the difference.
Arbitrary numbers?
The arbitrary numbers. In other words, arbitrary means this. We do not know the sequence of return of the market going forward, do we? We don't know if this year is a losing year or a positive year. So you could have been very fortunate to have been an investor and pulled out this kind of money during that sequence of years, right? And boy, you were happy.
Yeah.
But you could have been unfortunate Sam.
So what really should be happening is they should be showing you a chart with what the
Well, they should show you over different sequences of return or test over different sequences of return and would show the probability of success. And that's a lot of words to say this. We can all pick perfect periods of time in history that make everything shine. But we have to be aware that that was one period of time. We need to be aware of the risk of differing, changing events that can be negatively or can very negatively impact a plan. So in planning, and this is getting more heady than you need to hear, but we do sequence of return analysis. We take a rate of return, we take an expectation of return, and we use some probability devices called Monte Carlo. It's a horrible name to even reference. You think it's gambling, but what it's doing, it's testing probability of success. And so what you do is you want to test over a 10,000 sequence period of return. 10,000 sequences. And the way they do it in planning, if you can envision bingo, how the balls float up and they pull one out, the computers go through a bingo session where it chooses rates of return each year out of, who knows. And those sequence of returns are tested over the period of years that you're thinking of retiring. And they do it 10,000 times, and it comes up with a probability study that is far more reliable than simply looking at one historical rate of period. Everybody with me? I know this is, but I want you to understand, be careful with anybody showing you numbers and understand that you really want to see a sequence of returns over various periods of time so truly understand the expectation of risk and reward. All right. This is, we're talking about income, and I'm going to touch on this. Again, this is an idea of how also a client who we had, who is 59, was targeting a retirement age of 67. And so he had 8 years to grow his capital till retirement and then wanted to take out income to help in retirement. His goal was to take out about $28,000 a year off of his portfolio. He started with $300,000 and wanted to have an investment that at the end of 8 years was going to provide him with $28,000 a year. Everybody with me?
Yeah.
Okay. So what we did is we analyzed, well, there's two ways to do that. We could put the money, that $300,000, in a stock and bond portfolio and hope it grows over 8 years to the number we need. Or we could put that money in a guaranteed income account. And again, I'm referring to annuities as a classification right now. And what we discovered was, for this client, at the time they came into my office, we could buy a guaranteed income annuity that would provide him just shy of that $28,000 goal. It was $27,835. As the alternative to having to invest that money and having to earn 7.01% in the market each and every year for 8 years. This here was guaranteed. This here was not. Are there any 7% guaranteed returns out there today in the stock and bond market? There isn't. Doesn't exist. Okay? The point of this is just showing how we look at assets. We're just trying to find ways of how do you position an asset to generate an income stream that's going to accomplish your goals. We have the choice of how we invest money to make that happen, right? So we always want to make sure we compare assets to assets, risk to risk, to see what is the most logical way to accomplish that goal. So far, so good? Okay. All right. So this is just some Q&A that the author brings to your attention. You know, what do you want in terms of your income? How much of it do you want to be guaranteed? All right. Guarding against inflation, and this is the other goal that he has set in the book that we're going to look at. It's guarding, what do we do to protect ourselves? We've touched on this issue, inflation, what can happen, what the risks are. And again, just to kind of emphasize the point of this is that inflation is a fact of life, that higher prices of goods and services happen. And so, I'm not going to beat the dead horse here. You already understand this thing called inflation. But the key thing is, and I've said it before, you have to plan for the reality that inflation is going to be here. And in your planning you do, in forecasting you do for your income, you need to affect for the negative impact of inflation. That means you have to increase your goals. If your income need today is $3,000 a month, that's today's dollars. You need to forecast future rising income needs in the future. Okay? All right. This is the fourth one, and I believe the last of the goals, and that we're going to get to, and that's limiting taxation. And basically, the dialogue in the book that we have on the tax issues are ultimately, you need to be aware that even in retirement, right, taxes don't go away, do they?
No.
So when you start your planning, whether it's Social Security planning or withdrawing monies from various assets, we're going to look, a little bit more detailed at this, but you got to be aware of when you start pulling money out for income, what are the taxes due from each of those buckets, right? So the planning you do in advance of the need is where are you going to pull the money from as you start needing your retirement income? Do you take it from your 401k accounts? Do you take it from your Roth accounts? What's the difference between a Roth and a 401k? A huge amount, isn't it? One's taxed and one's not taxed. And so the planning that we need to go through is I need to define what I need in retirement, and then I have to define where's the source of that money coming from, and ideally, what's the source that has the least amount of tax impact on how you withdraw. Now, it's going to be more conversation we'll have in one of the next sections of our class, but this directly will impact many of you about the decision you make for what? Social Security with elections and withdrawals. Is this thing called gap planning, that we look at what you have with your Social Security benefits and say, all right, here's the optimal thing you ought to be doing with your Social Security plan, but if it's to not take Social Security till a later date, how do you fill the gap for the need while you're retired? And then where do you pull the money from to fill the gap, right? So we'll look more. But anyways, I'm kind of floating through that, but you can see on page 58, there's more dialogue and discussion about that. We're going to get in more detail when we get to the Social Security portion of our meeting. So let's do a quick review of what we've just talked through. 8 challenges: life expectancy, inadequate savings. We talked about inflation, taxation, market uncertainty, healthcare costs that are rising, unrealistic expectations, poor decision making. We talked about 4 goals, right, in planning: conserving what you have, generating income, how do you do it, guarding against inflation, and limiting taxation. So, we're a tad earlier than 11:30, which is what I was targeting for, so I want to first off open up and see if there's any questions. Do I have any questions so far about this part of what we discussed? Because we're getting ready to get into some exciting things about ideas and strategies. These are the problems, right? These were the, I had to get you through the ugly stuff first. But we're now going to dig down into some solutions and ideas and strategies. But before I go there and break, any questions that I haven't covered that were important for you? Okay? All right.